Well, good evening, everyone, and thank you for joining us. My name is Tim Graham from hotspotting.com.au, and I'm delighted to be your host of today's webinar entitled Self-Managed Super Funds Unwrapped, Building Your Wealth on Your Terms. The landscape of taxation and superannuation is changing all the time, and for everyday Australians, it is near impossible to keep up. So to help us navigate self-managed super funds and much, much more, I'm delighted to introduce our special guest for this evening, the founder and CEO of Optalife, Sam Wakefield. Sam, judging by the registrations and indeed our attendance tonight, I think we've found a subject that captivates the masses. So I'm really looking forward to your content tonight. But before we get into that, on a lighter note, I wanted to congratulate you on the birth of your second child recently. Congratulations.
Thank you very much, Tim, and thanks for having me on today and the Hotspotting group. It's always a pleasure to come on here and present. And Layla, we welcomed to the world 4 months ago. So we now have a 2.5-year-old and a 4-month-old. So definitely keeping me very busy.
Yeah.
And you're spot on. I think self-managed super funds we're seeing is a really hot topic at the moment. And statistics are showing that the amount of self-managed super funds that are getting set up and the industry as a whole is absolutely growing. So It's definitely a topic at the moment that's quite hot on a lot of people's lips, we're finding.
Excellent. Well, I know we had a really good turnout for your previous webinar as well, and you got a lot of business directly off the back of that. So I've got no doubt tonight will be no different. But before we get into that, just I suppose a little housekeeping. We'll have about a 45-minute session this evening, and then we'll allow about 15 minutes at the end of the session for Q&A. So I'd urge everybody, if you've got questions throughout the presentation, feel free to put them in the Q&A, and then we will have time for some questions in live time at the end with Sam. Anything that we don't get to, Sam will get a copy of your questions, and he'll obviously reach out to you after tonight's webinar. But Sam, look, to kick things off, there's probably a few people on the panel tonight that haven't heard of Optalife or maybe haven't seen one of your webinars in the past. So why don't we start there? Tell us a little bit about your business, Optalife.
Yeah, absolutely. So I'll jump straight into it and hoping you can all see the presentation.
Yeah, we've got you.
So who we are at Optalife, we really have one simple purpose, and that's to help our clients live their optimal life. Now, the way we help our clients live our optimal life is we build what's called a financial plan. Now, a financial plan, we really define as a roadmap of your finances. It's really to understand and define what your future looks like, and it's to put in place clear and understandable steps for you to achieve. So that's really what we're all about. At the crux of it, we're about looking at your situation. We're about looking at strategies that are really going to maximize your wealth. They're going to live the lifestyle you want to live and desire, and ultimately is going to help you live a long, successful Optalife. Self-managed super funds is just one component of what we look at. I won't go through that individual wheel there in an element, but we're a really firm believer that we want every element of your financial puzzle or every piece of the puzzle, so to speak, to be in line with your situation and goals. Today, we're going to focus really on SMSFs. It is one key component of what we look at, and it's a bloody important one, being the superannuation of that as a whole. So that's what we'll really focus on. In relation to what we do as financial advisors, we really want our clients and the journey we take our clients on to give them 4 key takeaways. We want to give our clients financial clarity. We want to make sure that they're in the right direction. They've got the right strategies. We want them to be confident about their future. We want to have our clients protecting their lifestyle. And at the end of it, we want to have some fun and live that optimal life. So that's really about who we are and what we do. Before I really jump into the presentation, so sort of the process and journey that I want to take you all on tonight, we've covered off on who we are and what we do. Before we really start to unwrap self-managed super funds and the key benefits and considerations of them, it's a good idea to reflect on what exactly super is. It's important that we know what super is so we know how we can then maximize it in that self-managed super fund environment. So we'll spend a little bit of time talking about what is superannuation. We'll then jump into what is a self-managed super fund. We'll really unwrap the key benefits, the considerations, how it works, what to be aware of, what are the legal requirements. What I then want to do is to kind of put you in some of our clients' shoes and go through some real life examples of some clients of recent that we've considered a self-managed super fund for, and some clients that we may not have been ready to look at a self-managed super fund as of yet. But what are some other strategies that we looked at to still maximize that super asset? And there we'll look at some final thoughts and next steps. So that's the journey that I want to take everyone on tonight. Before I jump into it, unfortunately, I do have to just have a little bit of a warning here. I won't go through the crux of reading through that, but just to make sure everybody is aware that tonight's presentation is general advice in nature. It has not been tailored to your personal circumstances, objectives, and financial situation. So please absolutely reach out from today if you do have any questions in relation to your personal circumstances. All right, let's jump in. What is super? When it comes to superannuation, I'll make a pretty bold statement here. I would say superannuation would be one of the most underutilized assets or resources that I would find our clients have. Superannuation is a phenomenal investment structure. What superannuation is, it is that. It's an investment structure designed for us to accumulate retirement savings. Our employer, or for those that are self-employed, our employer, we are obliged to contribute compulsory employer contributions into superannuation. So right now, super law states we must contribute 11% of our salaries into superannuation. That will increase to 11.5% next year, and that will increase to 12% the financial year after. So if somebody's earning, say, $150,000, they would have about $16,500 going into superannuation each and every year. Now, for someone that's earning $150,000 at age 40, let's say we have a 20-year working horizon behind us, our contributions alone would be somewhere near $500,000 going into superannuation. So it's some pretty decent investment that we would have going into that environment. Now, superannuation is a concessionally taxed environment. Superannuation has a tax rate of 15% on the earnings of the underlying assets or holdings within the fund. So what I mean by that is, if I have a superannuation fund that earns $10,000 worth of investment income, that investment income's only taxed at 15%, which potentially is far less than earning that equivalent income in our own name. In fact, if I'm earning above $180,000 per year, I'm taxed at the highest marginal tax rate, which is 47%. So from a tax vehicle, there is not much, if anything, in Australia that matches the full benefits of superannuation. To further expand on that, if I meet a condition of release of superannuation, transfer my balance into what's called an account-based pension. To summarise that simply, it means we start drawing down and accessing our super in retirement when we're able to. The tax rate reduces from 15% down to 0, which is a pretty phenomenal investment. So I could earn an amazing amount of money within my superannuation asset throughout retirement and basically pay nil tax, with an asterisk there that's based on up to $1.9 million that we can have in that phase at the moment. Now, where superannuation becomes really confusing, superannuation is a complex, tricky, confusing asset. There's no doubt about it. And I'd probably find that's why it is such an underutilized asset. It's confusing. We are limited to contribution caps. We are limited to when and how we can access it. The government can control some elements of when, how much we can put in, what is the tax rate, which I'll probably find why it can sometimes be a little bit tricky. And what we find as financial advisors, we're here to navigate those intricacies. The last point there is a really important one, and I guess the key of tonight's webinar and topic is the choice of super fund really will dictate how your money is invested and how much control you have. So that's really what I want to focus on tonight.
Sam, I know we've got like $3.5 billion worth of superannuation in Australia at the moment. What percentage of super funds are self-managed at the moment?
So Good question. It's actually 3.5 trillion. So the Australian superannuation industry is worth $3.5 trillion. Out of that, SMSFs make up about 25% and have been increasing at about 2% over the last few years. So the SMSF industry, from a dollar figure, is worth just under 900 billion.
Well, I think, superannuation's always been a bit of out of sight, out of mind. And what self-managed super funds do is bring it to the forefront so you now have choice.
You're absolutely spot on. And when I go into some of the next slides, the key benefit of an SMSF is we feel like it's our money. If I can't see, touch, or access something for 20 years, it doesn't really feel like it's mine. And an SMSF really just takes away that downside or that inflexible nature of super. What I quickly want to touch on here are the different types of super funds, which will really be a good transition then into the full investment or the full capabilities of an SMSF. And I know there's quite a lot on this slide, so I'll start on the left, which is an industry fund. So what does it mean to be invested in an industry fund? What we tend to find is industry funds, they're really great for small balances, really cost effective for small balances, but they are really limited to an investment menu and investment options. Most industry funds would have 10 to 20 different investment options that we can choose from. Out of those investment options, there might be a high growth, a somewhere in between, a low risk, maybe a share fund or a property fund. Out of those options, we really don't have any say to then the individual assets that those investment options own. There's generally no direct investment options. What I mean by that is we generally can't buy shares, can't buy ETFs, can't buy things that we could potentially buy in our own name within a self-managed super fund.
And not only buy, Sam, but also sell.
Absolutely, absolutely. Pooled tax structure. Sometimes this can be a little bit of a tricky one to explain, but it might make a lot more sense when we start to talk about the individualized tax structure of a self-managed super fund. Within, say, for example, a super fund environment, they're managing billions and billions of dollars of investment. So they're constantly buying and selling investments on behalf of their members. What a pooled tax structure means is, unfortunately, every member suffers that tax consequence. It may not be an asset that member holds, but they're pooled across the whole investment vehicle. We cannot control potentially when assets are bought and sold within that investment vehicle. We generally cannot transfer to pension phase without realising a capital gain. Now, I'm going to just park that for a little bit and explain that when I talk through the other funds. A retail/wrap account. They, in theory, are quite similar. A retail super fund is something that any member of the general public could go and get. A wrap account tends to need to be advisor driven. So you've got to go through an advisor to get a wrap account. But what does that kind of mean? You generally do get access to a far larger investment menu. So some wrap accounts, for example, will have thousands of different investment options that we can choose from. They'll have access to more specialized investment options. So we might get a client that comes to us that says, Sam, I want to invest my money in a social responsible way. Well, I have the ability to explore some of the best breed social responsible investments in the marketplace. So we can be a lot more tailored there. We will have generally access to direct investment options. I can buy and sell shares, ETFs. We find the balances tend to be more competitive as the fees tend to be more competitive, as the balance grows. A lot of wrap accounts, retail funds tend to be capped. So if your balance reaches a certain amount, the fee structure stops. Far superior reporting and functionality. So the look and feel of these types of super funds do look and feel a lot more
really
like
a self-managed super fund.
Yeah, absolutely. Flexible pension options, an individual tax structure. So really what that means is I can buy and sell my own investments. I have more control on when those investments are bought and sold. You're spot on. They are, in theory, a lot of the benefits of an SMSF we can do in this type of fund. We just don't really then have the added paperwork and the time required to run an SMSF. And we generally can transfer assets to pension phase without realising a capital gain.
So would I be right in saying that with something like a wrap account, it'd only be one shareholder as well?
Well, look, it's still governed and run by a trustee, but the assets are more bought on an individual level.
Yeah.
So they're still, in a way, you're looking at professionally managed type of investments.
But you couldn't what I mean by that is you couldn't partner up with a wife, husband, nothing.
No, still generally a
Sure.
one-member fund. Yeah,
sure.
Yeah. With that said, we can talk about some solutions that we can have similar characteristics to a wrap account and similar characteristics to an SMSF, and maybe pool the balance. We can talk about that a little bit later.
Sure.
So that transitions us into an SMSF. Now, I will be going through the SMSF benefits in a lot more detail, but in just a quick summary, an SMSF, we have the ability to pick and choose your own investments. With some limitations, we can basically do whatever we could imagine doing in our own name within a super fund environment. So we can hold direct investments. We can hold direct property. We could purchase artwork, classic cars, wine, jewelry. We could gold as an example. We can purchase a variety of assets in that fund. We can pool funds with up to 6 members. So we could have potentially mum, dad, 4 siblings. We could have 6 business partners. We could have one fund that could meet the needs of up to 6 people. In some circumstances, we're able to borrow money. We tend to have fixed admin fees. So what we would find with an industry fund, a wrap retail account, they do tend to be percentage based. So the bigger the balance, the bigger the fees. An SMSF tends to work a little bit differently. We have flexible pension options. I haven't touched too much on pension options, but what it might mean is we can choose when we want our fund to pay our benefits, what day, what frequency, what time, whereas we might not have those full benefits with another fund. We absolutely have an individual tax structure. We can buy and sell investments on our terms when we want to. We're not forced, or the super fund is not doing things when they feel it's best to do it. We 100% control that. We have flexible estate planning. So super can be a really great way to protect our assets. We might want our assets to potentially boycott certain people or boycott a will or not flow through to a will. And an SMSF is a way that we can have far more flexibility and control over our estate planning, and we can transfer to a pension without realising a capital gain. And that's a really big benefit I'll touch on a little bit further. So that now is going to lead us into that super. That's the different types of funds we can have. So let's really now unpack what an SMSF is and how we can really assist to build retirement wealth on our terms. So what is a self-managed super fund? In simple terms, it's a superannuation fund that can have up to 6 members. All members must be a trustee of the fund, either as an individual or as a director of a corporate trustee. The responsibility then of an SMSF trustee is for running the fund, making investment decisions that will affect the retirement interests of each member, and the trustee is also required to ensure the fund complies with Australian super legislation. So if we go back to the previous slide, a wrap account, a retail fund, an industry fund, they would have a trustee that runs that fund on behalf of the members. The trustee is the one saying what we can and can't do, picking the investments, making those decisions. So an SMSF, we become our own trustee, we become the driver of our own destiny with that benefit of being a trustee. With the example that I've got there, this is a fund that has potentially 4 members. That might be husband, wife, 2 kids, that might be 4 friends, that could be 4 business partners. What will happen within a self-managed super fund? The individual will contribute their superannuation to the fund. We might have a fund that has $1 million of a total balance and 4 members. Each of those members will have an individual account balance. So their initial contribution, their growth, their ongoing contributions makes up an individual member balance and is a component of the total pool that sits in an SMSF. Now, an SMSF is legally required to have a bank account that accepts all of those contributions into it. Once that money's in the bank account, those up to 6 members can pool their money together and go and buy the investments that they choose to buy. So things like real direct property, managed funds, shares, business, other assets that we touched on, classic cars, artwork, gold, silver, you name it, with certain limitations, a self-managed super fund can do it. That income can then be directed back into the cash account or reinvested back into those investments and used to continually buy more and more and more wealth. At retirement, member one decides that they want to now access their balance. Based on what the total funds value is, they'll have their allocated member balance that they can now start to access. So a question that we probably get is, a lot of people might not realise they actually have their own individual balance within the SMSF. You absolutely do. You can still pool your funds together, buy and sell as many assets that you want, but you're always going to have your individual balance as part of that.
Yeah.
So to touch on again some of the key benefits of an SMSF is the fact that we do have full control over the assets that we have. So we have absolute freedom to set our own investment strategy and select the underlying investments that meet our own unique preferences, life stages, etc. We have choice. So we have that choice to buy assets that we just wouldn't otherwise be able to do in a traditional super fund, like property as an example. There is the option for reduced costs. So given that self-managed super funds do tend to have set administration fees, they can be cost effective for those that do have decent balances. Given that we can control our tax obligations, we can control when we buy and sell investments. So by controlling when we buy and sell investments, we can control things like capital gains. That can assist to reduce the overall costs associated with our super fund. And we have flexibility. So a self-managed super fund, just like maybe a family trust or investing in our own name, is a highly personalised, flexible vehicle that can facilitate a range of strategic options. So really,
so just on the costs, I know there's probably been a bit of a rhetoric around self-managed super funds being more expensive than your traditional fund. But my understanding is obviously if you were to speak to a financial planner, you would get a recommendation based on whether or not it was going to be more affordable or more cost effective. Would that be accurate?
Absolutely. So the cost is an interesting one because a lot of it's going to be defined and dictated by what we're investing in. Now, for those people that do want to manage their investments themselves, maybe buy and pick their own shares, the costs of a super fund can be really, really minimal. And I've got some examples of where I will walk you through some costs for individual scenarios. But it is a case-by-case scenario. Some instances, the fund could be far more expensive to run. Some instances, it could be far more cost-effective to run. It really does depend.
Really comes down to the strategy. Yeah.
Absolutely. And for us, it is absolutely vital that we do outline all of those benefits, but costs and disadvantages when we build a strategy for our clients.
Sure.
Really good question. So some of the things to consider with a self-managed super fund. I've got 4 key things here to discuss. The first of those is onerous legal and compliance obligations. So given we are our own trustees of our own super fund, we must keep up to date with relevant legislation. If there are any changes in superannuation law, we must know and make sure our fund's adhering those. We also must ensure that all administration obligations are complied with. So with a self-managed super fund, it must complete a tax return every year. It must pass an audit every year. It must complete a member statement for all of its members. All of those things that your current fund does that we probably take for granted, that all lies directly on the trustees' shoulders. Lack of time and expertise. So we need to have time and expertise in managing our investments. Now, the benefit of, say, an industry fund or a retail or a wrap account is quite often we are investing in professionally managed investments. Yes, we might not have a lot of control and say over those investments, but there are a team of professionals that are really making investment decisions day in day. Unless we have the time, skills, and expertise to do that, we may have a poor performing fund. We may not be investing in the right things, but you may work with a partner like myself to help with those investment decisions and making those and managing them. There also is the time that goes into compiling your annual tax returns and audits. So think about, we do a tax return in our own name. If we own a variety of investments, we've got to compile all of that data and give it to our accountant. We are basically doing that on steroids for our SMSF. So again, it can be a little bit of a double up in compliance requirement. I've got their lack of access to certain government bodies. So within an industry fund, a retail fund, a wrap account, if the trustee of that fund makes a really bad investment decision, I have cost-effective resolution systems I can go to. I have a legal framework in place where I can complain to bodies like AFCA if my super fund's not doing the right thing. You don't have access to those in your own super because it is unfortunately you as the trustee making those decisions.
I think I'd be making a complaint about myself.
Exactly. And I've got a bit of a double up there. I've got costs. So I've got costs as a benefit. I've got costs as a disadvantage, because you're spot on in your question, Tim. It may be really beneficial from a cost point of view. It may not be beneficial from a cost point of view. But an SMSF does have some unavoidable costs. It costs money when we set up. There are establishment fees. It costs money to pay our accountant and administrator to do the tax return every year, to do the audit every year. And there also are costs for professional services like a financial advisor, like a legal or accountant, and there may also be investment costs on top of that. So really important that we look at that. In my experience of doing what I've done for the past 14 years, if I look at probably the number one out of these 4 considerations where I would say clients struggle with is that lack of time and expertise. Yeah. If I've looked at reasons why we've decided, or if a client set up a super fund and they've come to us to make sure it's still the most beneficial thing, the most common theme is I wasn't aware how much time goes into running it. Now, I'm not saying that's a negative thing. We just need to be aware of, like any investment, we've got to fully understand what we're getting into. And again, quite often it's more costly to exit than it is to enter. So I think it's
let's talk about the exit a little bit, Sam. How often have you seen people wanting to close up a self-managed super fund and put the balance back into a managed fund?
Look, we would wind up 1 or 2 funds a year, to be honest with you, and that can be for a variety of reasons. It can just be, I'm now retired, I don't want that, I just want life being simple. It could be a divorce, it could be relationship breakdown, or it could just be, you know what, I made a poor decision 10 years ago. I just want life to be a little bit easier. So look, it's quite common. There's probably been years where I've wound up more funds than set up. But again, it just goes back to advice. It goes back to people not really getting appropriate guidance on what they've done.
Sure. Okay.
So that's an SMSF. That's the benefits. That's the considerations. What are some key rules and requirements that we need to be aware of? So when it comes to a self-managed super fund, there are 5 key rules or 5 key investment considerations and rules that we must follow. The first of those is the sole purpose test. So the sole purpose test states that an SMSF must be maintained for the sole purpose of providing members with retirement benefits or dependents with death benefits. To put that into layman's sort of terms, basically we can't get any benefit from our super that we otherwise wouldn't have been able to get with a traditional super fund. So probably a common question that we might get as advisors is, can I buy a holiday home in my super fund? Or can I buy a property to live in my super fund? Well, that wouldn't meet the sole purpose test because you're getting a benefit of that asset. Whereas again, that asset needs to be solely for retirement benefits. Number 2 in-house assets. So super funds are restricted from investing more than 5% of the total funds into an in-house asset. With that example, let's say I bought a holiday home and I spent 6 months of the year living in that holiday home and I bought it in my self-managed super fund. That would technically become an in-house asset. And I would fail not only the sole purpose test, I would fail the in-house asset test. However, I'm limited to 5% of my funds being able to be held in an in-house asset. So if I had a fund worth $1 million and my holiday home, if you could find one, was worth $50,000 or up to $50,000, I could actually have that as a holiday home. So I could still potentially get some benefit from my assets, but that would be limited to a value of 5% of the total fund balance.
And Sam, a couple of questions on that. One of them being, the superannuation rules are really there for retirement, meaning that if we think about it, we can't benefit from it, a lot of these assets, until retirement. If you think about it like that, that really covers a lot of these rules as well. Is that correct?
You're absolutely spot on. So let's say I've got all of my money, I'll pick on a provider here, with Australian Super. I'm 40 years of age. I can't get access to my super. I can't call Australian Super and say, hey, give me $20,000. I can't. In a self-managed super fund, I potentially have the ability to do that. I could take money out. I could go and buy an asset that, for example, I could go and buy artwork or a car that I drive. I'm getting a personal benefit from. That completely contradicts the rules of superannuation. So that's why these things are set up, is really the way to think about it is I can't get any benefit of my superannuation monies than I'll be able to get in a traditional fund.
Yeah.
Number 3 is borrowing restrictions. So a general rule is that a superannuation fund cannot borrow money. The exception to that is under a limited recourse borrowing arrangement. So i.e. I buy a property, I can borrow. Arm's length dealings, an SMSF must be made and maintained on a strict commercial basis. So some questions and examples of that would be, I've got a friend that's selling an investment property. He can sell it to me for 20% less than the market value. I wouldn't be able to buy that in an SMSF because it would have to be on strict commercial market terms. The other question might be, could I rent my investment property to a mate for 20% less than market value? No, I can't. Again, it's got to be a market value.
So
Number
Sam,
5.
who's auditing these rules?
Yeah, good question. The ATO sets the rules and requirements of what we can and can't do. The fund must pass audit every year. So the fund must have an auditor that looks at all of these things. And if they pick up on anything that, hey, I need to question this, that's when potentially there can be some reporting back to the ATO. And the ATO may penalise you. The ATO has a variety of penalties and restrictions that they can place on an SMSF if it's not doing the right thing. 5 is acquisition of assets from a related party. So questions that would probably get quite a lot as well is, I own an investment property in my own name. Can I transfer that into or sell that to my SMSF? The answer is no. And the reason being, we as an individual are a related party to our SMSF. So we can't transfer money in. Questions we would get quite a lot is, can I rent the property to my son? Can I rent the property to a relative? Well, no, you can't, because it's a related party of you. So there are some restrictions there. What I want to quickly touch on now is some key investment strategy requirements. So the ATO says once we set up an SMSF, we must have a fully documented investment strategy of the fund. And the investment strategy must address 6 key requirements. The investment strategy must address the member's objectives. So we need to consider the circumstances of every member. That may include things like the age of the member, the retirement needs of a member. Where I've sometimes seen self-managed super fund go wrong is we set it up with someone that doesn't have the same objectives of us. Generally, a husband and wife, we're working towards the same thing. We're working towards a life together, a retirement together. So we're buying assets that are suitable to us both. Sometimes where it can go wrong may be, I'm not invested in a fund or assets with someone that's got similar life stages or objectives than me. So it's important to look at we must look at risk and return. The SMSF must consider what type of return it wants to achieve and then must pick the right assets to achieve that. And that must be fully documented. An SMSF must address liquidity. So we must have sufficient cash flow and assets to ensure expenses and benefits can be met and paid. Now, I'll speak to that through a property-specific lens in a little bit. An SMSF must address diversification. So diversification, the age-old adage, we don't want to put all our eggs in one basket. That's exactly what diversification means. And our fund is required to consider that. If we put all of our eggs into a property, we can do it. But we really need a good reason and documented strategy around why we've done that, why we haven't looked at diversification, and what is the fund doing to minimize maybe that property-specific risk. We need to look at the ability to discharge liability. So an SMSF must be able to meet liabilities such as retirement benefits and death benefits. This is probably something that a lot of us don't fully understand when it comes to superannuation death benefits. If a member of a super fund passes away, the super fund must pay that balance generally as a lump sum death benefit. It can be taken as what's called an income stream, but generally, if I pass away, my super fund has to pay my balance to a beneficiary.
And obviously, if that's a property, especially one that's still got debt on it, not producing positive income, or at least a considerable amount, that would have to mean that they'd be required to sell it.
You're spot on.
And
so
within a quick time frame too.
Correct. So if I don't have enough liquid assets or non-property assets in my super fund to pay out potentially the member account balance for my husband and wife. Unfortunately, I've lost my wife. She had the bigger balance, but it's all tied up in property. I'm forced to sell that potentially. So, and that can be the same at retirement. I tend to not want to retire with debt on a property because it defeats the purpose of potentially having that property. I want to retire with the income. So how am I going to pay retirement benefits if all my money's held in a liquid asset that might not produce as much income as I need, but potentially still has a loan? So really big considerations. And insurance cover, really important that an SMSF is obliged to consider insurance cover for its members. So look, there's definitely some intricacies. I don't want those to come off as a negative, but it's really important that we understand that there are some onerous legal and compliance obligations of a super fund, and there are some really key considerations that we must look at. When done correctly, an amazing vehicle. When not done correctly, can be costly, time-consuming, and a bit of a headache to run.
Yep.
What I've got here is just looking at some SMSF and property now sort of specific requirements. So we see one of the key reasons that a lot of our clients want to set up a super fund or an SMSF is to buy property. It does tend to be a really beneficial asset to hold in a super fund, and we see that as a really popular strategy for a lot of our clients. Now, when we buy property in a super fund, we do tend to borrow money. We borrow that money under a limited recourse borrowing arrangement. When we do that, there's some strict requirements that also need to be met. So the trustee of a super fund...
Could you explain for listeners what the limited recourse borrowing actually is?
Yeah. So a limited recourse borrowing arrangement is a little bit different than, say, buying a property in your own name, because there is a really strict super law requirement that sits above SMSFs. So what we basically need to do is we need to acquire that property separately from your SMSF. So we would need to set up something called a bear trust. That bear trust is what would borrow the money from the lender, and the bear trust is what would buy the asset or the property asset on behalf of the super fund. The SMSF pays the loan, the property income's paid into the SMSF. But where that limited recourse borrowing arrangement comes into it is the bank can't come after your SMSF assets if potentially we're forced to sell that property and we owed the bank some money. So the strict requirements are that recourse is if I'm forced to sell that property at a really big loss, the bank can't come after my other super fund asset. So it's probably a little bit more riskier for a bank to lend in an SMSF environment. With that said, I haven't come across a lender that wouldn't make an individual or an SMSF trustee, generally they'd make them sign a, basically that you've got recourse to your personal assets. They generally sign a personal guarantee. So if shit did hit the fan, that maybe they can come after you personally, but they can't come after your SMSF.
Yeah.
But there's some really strict requirements that comes to, and I'll touch on. I'm going to look at the key benefits of owning property in super is I've got the property asset. What I can potentially do using that limited recourse borrowing arrangement, I can take, say, a $300,000 super balance, and I could leverage that up to a $600,000 super balance. So I'm getting the benefit of that accelerated growth because I've got a greater exposure to an asset base. I'm then getting the growth of that $600,000 property. I'm getting the rental income of that $600,000 property that will go to meet a lot of the ongoing expenses or loan repayments of the fund. Superannuation is that concessionally taxed environment. So the benefit being I could have a property earning me $30,000 a year in rental income. I would only be paying 15% tax on that rental income or potentially tax-free if that rental income is in pension phase. Just like when I own property in my own name, I'm generally able to have tax deductions. So if I own property in my own name, I can generally deduct expenses such as council rates, interest, property management, depreciation from my tax. You can do the same in super, but it's deducted from that 15% tax rate. So that can potentially reduce the amount of tax that your super fund pays you. Now, I said, I'll sort of park this comment because I'll come back to it. The ability to transfer and sell in pension phase, potentially reducing any CGT. Let's talk through that. I buy a $500,000 property in my super fund at age 40. I'm now age 60. I'm retired. I decide to sell that asset. That asset's now worth $1.5 million. I'm able to transfer that asset from what's called accumulation phase, my 15% tax-paying environment. I transfer that asset into pension phase. I do that without realizing any capital gain. Now I sell that $1.5 million asset when I'm in a tax-exempt pension environment. I've made $1 million capital gain and I would potentially pay $0 capital gain tax. So a phenomenal benefit of superannuation and a phenomenal benefit of property, which is a really strong growth asset, especially if we've borrowed money to accelerate that really is limited to a self-managed super fund. There's a couple of considerations that we must look at. Under a limited recourse borrowing arrangement, the asset must be what's called a single acquirable asset. So what that basically means is I've got to buy kind of one thing. So if I buy a property, that property needs to be on one title, one contract generally. Some examples of things that might not be single acquirable assets could be buying land, borrowing to buy that land, and then building on that. It has two separate contracts generally, so that might not be what's called a single acquirable asset.
This includes doing renovations to properties. So it's pretty much you can't do improvements, but you can do repairs.
Yeah, absolutely. So you can't materially change the asset. So I've got a 4-bedroom house. I decide to demolish that house and build a 6-bedroom house. I generally can't do it. I want to develop my property, turn my one title into 2. I generally can't do it. Again, while I'm under a limited recourse borrowing arrangement. If that property is owned outright in the SMSF, I can do all these things. It's just under that. Just a bit conscious of time here, Tim. So, look, I might not go into a huge amount of detail with these things, but what we've got to look at with property, it's an illiquid asset. So, again, we look at the SMSF investment strategy. We need to have liquidity. We need to have diversification. Property might not meet that, so we need a game plan around it. How we deal with property upon retirement or death of a member. We kind of touched that on a previous slide, but we've got to, as financial planners, plan for those worst case scenarios. And again, the last thing we want is we never want to sell an asset at a really bad time. So we need a strategy around addressing those things. And sometimes we can find property can be a bit of an expensive asset to buy with things like stamp duty and to run. So we've got to make sure the SMSF has the right cash flow and ability to cover all of those expenses. Okay, so will it work for me? I'll go through these really quickly. I won't spend too much time on this. A lot of the benefits we've covered off on, but I've got here two clients, two different outcomes. So let's meet Nicole and Jason. Nicole and Jason are 50 and 48 respectively. They have a home worth 1.6 with 300,000 owing. They've got a couple of investment properties worth 1.3 with $1 million owing. Earn a really good income, really good passive income with some rental income. Now, this is a real life scenario with names just slightly altered. They had just over 350,000 in super, had a decent amount of savings, and had some surplus cash flow of about 50,000 per month. Now, they came to us with a couple of really good goals. Those goals were wanting to be more proactive with their superannuation. They were really interested in an SMSF. They wanted to build wealth, and they had a really strong comfort level with property. They wanted to continue on that property path and property journey, albeit their borrowing power in their own name. They earned a really good income. Their borrowing power in their own name wasn't too fantastic. They wanted to aim to retire by the age 60, and they wanted to protect their assets.
Mm-hmm.
So what we did in this scenario, we absolutely looked at a self-managed super fund, and SMSF was a perfect retirement vehicle for Nicole and Jason, and we established a fund. The fund looked like this. We took out a $30,000 and retained that in a cash management account. We gave them liquidity to meet that liquidity requirement. We made sure they had about 6 months worth of fund expenses sitting in cash should anything unforeseen happen to their property rental income or their contributions. We bought a property of 650,000. We could have done a bit more, but that was a really solid amount for the overall strategy and game plan of the SMSF. We had a loan of 455,000, and we made sure we paid that loan off well and truly prior retirement. So we looked at a strategy to pay that debt off in 10 years. And we also had about 70,000 left over that we invested in a diversified investment portfolio. So for this specific scenario, we looked at some shares and ETFs worth 70,000. Again, diversification, liquidity of the fund. What were the costs involved for that? I'll look at the bottom. When we set up an SMSF, these were the specific costs of the clients. Now, this will be different for every individual, but if we have a look at really quick cost to set a fund up, establishment of about $715. We looked at what's called a corporate trustee structure, which was $990, and the limited recourse borrowing arrangement, setting up a bear trust and the company to purchase the property. That tends to be the more expensive component of a fund setup. They were looking at about $3,000. So if we look at costs, potentially about $1,700 to set up an SMSF without a limited recourse borrowing arrangement. A little bit more on top of that if we do that.
If we look in layman's terms, Sam, for a lot of people that have heard, that there is quite an expense in setting up a self-managed super fund, the real expense is in the setting up of the limited recourse borrowing facility, which is the bear trust for buying property. If you're looking to invest in other things, it can be a really affordable strategy. I mean, there's huge benefits to being able to leverage with property, but obviously for those that are looking to invest in other asset classes, you can do that. And you don't have to move all of your superannuation from your balanced into a self-managed super fund to get the benefits of a self-managed super fund.
Correct. Yeah, I absolutely agree. And again, those costs there, they could be cheaper from providers. We work with a variety of different online providers, different accountants. So that's probably a good average, but I reckon we could get down on that as well. If we do just have a little bit of a look at the running costs, I've got their investment cost, $203. That is for their shares and their ETF portfolio, their non-property investments that they had. The SMSF and administration fees, that's that set ongoing running fee. That's their annual tax return, audit, member statement, about $3,000. Unfortunately, the ATO and ASIC do want a little bit of fees from your SMSF as well. So in this instance, was about $581. We must disclose, and you must really be aware of what the other costs are, because properties aren't cheap to run. There is interest costs associated with the property. there's ongoing property costs, maintenance, insurance, etc. So all of the things that make up the cost of an SMSF, and that in that instance was more expensive than their current fund. But when we looked at the growth, the benefits, and the advantages over a 10-year period, it far outweighed what their current superannuation strategy was.
Mm.
I'll have a look at our next client, which is Lily and Hayden. Lily and Hayden, they're about 40, one investment property, home mortgage, decent income. The main thing to highlight here is we had about $211,000 in super, so not as much as the previous client. They were saving about 14 grand per year. Actually have 2 kids under the age of 5 as well. So their goals were around reviewing their super. They were interested in a self-managed super fund, interested in being a lot more hands-on with their super strategy. They wanted to build and grow their wealth. They wanted to pay off their home loan, and they really wanted to help their kids financially as well. So what we did for these clients is we did not look at an SMSF. The key reasons why we did not look at an SMSF is we opted to establish a wrap account. We looked at a fund that can still give them a lot more say and control of their superannuation, being that wrap product. But at their stage in life, it was more cost effective, and we just kind of wanted simplicity. They wanted to focus on their kids. They wanted to focus on other sort of more time-consuming things in their life stage. So we didn't look at an SMSF for now. We determined their balance wasn't sufficient to warrant the costs, nor could the fund purchase a property at this stage. So we looked at that option. They just didn't have the right balance to buy property or the property that they would want to purchase. So instead, we opted for a personal investment strategy. We focused on reducing their debt, and we built an education plan for their kids. But what I wanted to quickly highlight here is if I didn't look at a property investment, what would the fees of my superannuation or my potential SMSF be? So when Hayden and Lily, with our recommendations on the right there, I've got the fees of our recommended super fund. So 142 and 68,000 respectively in super, their account fees, their admin fees, their investment fees. They were paying total fees of about $700 and $370 each. Their fees were about 0.5% of their fund balance. Now, we about halved their current super fund fees. If we did an SMSF, I won't go through all of the individual fees, conscious of time, but the total fees would have costed round about 1.6%. Now, potentially that SMSF admin fee could be lower based on the provider you go to. In this instance, if we were going to look at an SMSF for Lily and Hayden, they wanted a bit more professional managed investment fees. So if I was going to buy and sell shares or purchase investments that don't have management fees, those investment costs could be less. So I'm not saying that a 211,000 balance couldn't warrant an SMSF. In this instance, it just didn't. Now, it's worth noting there's no minimum cost or no minimum balance to set up an SMSF. You could set up an SMSF with $1 if you wanted to. It really just depends on the investment strategy, what we're looking to achieve, all of those key things wrapped into how we look at it.
Sam, on that subject, I know people often ask that. That's probably the number one burning question: how much is the minimum that you would consider? And I know, through clients that you and I have worked on together in the past that, that some people have said, look, I want to set up a self-managed super fund and I want to buy a property. And you have said, look, I'm suggesting that we don't because your fund isn't high enough. So I'm interested because there are certainly financial planners out there that would suggest property for that same candidate. What is the reasoning behind that from your point of view? What is the minimum balance and why is it that they could go elsewhere, but you chose not to?
Yeah, look, really good question. I guess for me, it comes down to the ultimately assets we want to buy, and is that asset that we were going to buy a great long-term investment? So look, if I've got a $300,000 balance and I'm comfortable buying a $400,000 property, that may work. But if I'm looking to buy a $650,000 or $700,000 property, it may not work. I think for us, we really want to focus on that investment strategy requirement. I want to look at making sure that a fund meets those 6 key things that it needs to. That is, liquidity, diversification, meeting some of those sort of retirement benefits. Look, it's probably quite rare that we look at a fund in particular to buy property under, say, 300,000 as a combined balance. That's not to say that it's not doable or we don't do it. I'd just say when you factor in the costs, the lower the balance, more of our superannuation, really the lower the balance, the more costs that are involved. We really need those investments to far outperform what they otherwise would if we had a bigger balance. So, look, $300,000, but absolutely case by case scenario, and really will be based on what we want to achieve in the investment strategy. Yep. For those that don't want to buy property, look, I think there could be merit in an SMSF for almost any balance. And there are some really low cost providers out there, far lower than the fees that I've got there. You might have to do a little bit more on your own account. But look, really, if the objective is you want absolute control, transparency, and say on your retirement journey, look, sometimes to get that, you might need to pay more fees. So, look, it just really depends on what we're wanting to achieve.
Very good. Okay. Final thoughts?
Yeah, so look, from here, really, if the question is an SMSF right for me? Hopefully today's painted a really good picture on the benefits, the considerations, what you need to look at. Why would you see a financial planner to set up an SMSF? And it's exactly a lot of those things that I've spoken to you about. We are going to build that roadmap for your super. I'm not just looking at, is it right for you now? We are looking at a game plan up until basically retirement on how we can maximize that asset. But some final thoughts. Really, we're about goals. Optalife is all about building a financial plan and roadmap to live your optimal life. So what's important to you over the next 1, 3, 10 years? Is it important to have control over your super? Do we like the idea of property and all the benefits it has in super? That's what we would really think about today. What to do when you see a financial planner? Look, I think it's just to see us with a bit of an open mind. We will always catch up, give our clients an absolute, honest, open discussion on what we think they should consider and look at. Again, conscious of time, so I might not touch too much on that. Next steps for us. So as a thank you for every single attendee today, what Optalife and myself are offering is a free 30-minute superannuation and financial health check. So I've got a QR code there that you can scan in. That's a session where we can dig a little bit deeper into your current position, talk a little bit more about Optalife, talk a little bit more about next steps and any questions you've got. And again, that's a completely complimentary service on our end for today's attendees. So, Tim, I haven't left too much time for questions, but
that's quite a lot of them as well. But that's okay. Look, to be honest,
underwater, mate.
It's great content though, and I think for what I took away from tonight is that self-managed super funds give you flexibility, they give you control, and if you're not the sort of person who wants to sit back and let other people play with your money, and you want to have a say in what you can do with it, then that conversation with you guys, 30-minute conversation to understand what your options are is well worth the exercise. And I can attest to working with Sam for a long time and had many happy clients. So yeah, I'd certainly urge everybody that is interested in learning more about self-managed super funds or is super in general to reach out and book an appointment. But Sam, we do have quite a few questions to go through. So sure. I'm going to try to get a couple. And I'm also very appreciative of the fact that at 8 o'clock at night here in Victoria and certainly 7 o'clock in north of the border, that people have sat around to listen to tax and superannuation until quite late. And we've kept the same number, if not more, than we started with. So you've done well.
Thank you.
The first question I've got is, I'd appreciate if Sam could touch on SMSF offset facilities offered by the lenders, whether they are self-managed super fund compliant, and the funds in self-managed super fund offsets can be used to purchase another SMSF property down the track.
Yeah. So look, if we look at an offset account, it's ultimately a bank account. It's just instead of that account earning you interest, it's offsetting interest on your home loan. So if a lender offers it, that offset account can be. There's no reason why that offset account can't be the cash account of your SMSF, or we can build our savings up in that offset account. Can it be used to buy another property? Absolutely, it can. As long
Assuming
as the
servicing
funds,
will allow it. Yeah.
yeah, correct.
Yeah.
As long as the fund can service it. One thing I probably didn't touch on in the limited recourse borrowing arrangements, one thing it's important to note with property and super is you can't use the equity in that property to
Yeah.
buy another property. It all has to be standalone, separate limited recourse arrangements. So we've probably got to look at a bit of a cost benefit analysis, but no reason why an offset account is just a bank account. That's completely fine.
On the same subject of the loans, I'm going to quickly skip ahead to a couple of other ones. One was in relation to the type of LVR that the lenders are offering at the moment,
Yeah.
and
Yeah.
also typical rates. Keeping
Yeah.
in mind, obviously, self-managed super fund loan is a commercial loan, so they're typically a bit higher, Sam.
Yeah, yeah. So look at LVR again tend to be similar to commercial. 70% probably a rule of thumb for most lenders. There's lenders out there that would do 80%. It's just really about, well, what are we trying to achieve? The more we borrow, potentially the more expensive it's going to be, but maybe the less cash that we have to put towards that. From a rate point of view, I've probably got to be careful. I'm not a credit advisor.
Usually
Rate,
a percent or two higher.
yeah, they're probably generally 1.5% to 2% higher than a residential rate. So unfortunately, they do tend to be higher, which probably for me is a reason that we like to do a bit more of a deposit than what we might do with, say, a property.
But also
now.
worthwhile noting for people from a strategy perspective, it's a bit different to, investments in your personal name where, we might want to use, interest only loans and use the tax benefits there. In a self-managed super fund, we'll be paying principal interest and trying to really pay off that debt as quickly as possible so that we're retiring with no debt on the property. It's unencumbered. So a lower LVR in a lot of cases could actually be more beneficial to you.
Yeah, I absolutely agree.
Okay, now this one's in a couple of pieces. So a question from Brett is, can we use our balance in a self-managed super fund as a deposit for a larger loan? For example, say 4 members had 600,000 combined. Could we purchase a property for 1.4 million, or can't the balance go into the debt? I'm not sure what that last part means. He said, I will to that add that it's a block of units that will be generating positive income, not to live in.
So, look, maybe just my understanding of that question. So there's 4 members, $600,000 potential combined balance.
Yeah.
Can they use that balance to borrow to buy a block of units? So from a serviceability point of an SMSF, look, the bank's just going to look at the income that goes into a fund, so the contributions, the estimated income off that property to service. So as long as the income of the fund, if I've got 4 members, I'll probably have some pretty good contributions coming in.
Yeah, that's true.
So from a serviceability point of view, look, it would be something we have to put forward to the bank. The only thing I could probably think of is the block of units, would they be a single acquirable asset? Probably not, because those individual units could be sold at different times. So generally with an acquirable asset, it's got to be bought and sold together. So I'd probably say under a limited recourse borrowing arrangement, I would absolutely say let's take it offline and have a conversation. There'd be a little bit more to unpack to give you a very appropriate answer. But I'd probably say under a limited recourse borrowing arrangement might be difficult to achieve. But there could be other structures and game plans and strategies around getting a super fund to do it. So let's chat.
Yeah, terrific. Brett had one more question in relation to borrowing money in a bear trust for a property. Can you borrow up to 80% like a personal residential loan, which we've just touched on? You can get up to that. So yeah, through a bear trust, it's not really that much different. You're not going to get a 90% or anything, but typically 80% is possible. 70% is more common. And then also, just take into account, it's not so much about your LVR. It's also about the servicing for those loans. So how much income's going into the fund.
One thing I'll just add to that is some banks do have a liquidity requirement. So a bank may want you to have a certain amount left over in your SMSF.
Yep.
And my experience is those banks that let you borrow more want you to have more cash or non-property assets in a super fund. So look, it could be we could borrow more, go up to 80%, but we might need to have a certain amount of money left over. So,
Yeah.
important thing to note.
Very good. Look, we do have a couple more questions, Sam, but I'll share those questions with Sam after we wrap up tonight, and he'll reach out to anybody who's done that. There have been a few people that have said they want an appointment within the Q&A. I'm not sure if you've used the QR code. That is the easiest way, but a few people have put their phone numbers in there for you as well, Sam, which you can reach out to.
Fantastic.
And there was also a couple of questions about a recording for this evening because a few people hopped on late. There will be a recording that will be sent out tomorrow. That should go out by midday. So anybody who registered for tonight's webinar will get a copy. Sam, thank you very much. I think we covered a hell of a lot of ground tonight. And as you said, we could talk about tax and superannuation till the cows come home, but everybody's got to get to bed at some point. So thank you very much. We look forward to having you again in the future. And as I mentioned to everybody, please take advantage of Sam's generous offer of 30 minutes for free. These are the type of sessions that are usually paid for. So you've got a really good deal there. Make sure you take advantage of it. And Sam, we'll chat again soon.
Thank you so much. And yeah, thank you, Tim. Thanks to everyone that joined in tonight. Hopefully you enjoyed it. And I look forward to catching up for a half an hour chat.
Good on you. Thank you, everyone. We'll chat again soon.
Thanks. Bye.